The buy, borrow, die strategy is how America's wealthiest business owners build and protect their fortunes, and they do it almost entirely tax free. It's a powerful concept, but most explanations of buy, borrow, die stop right where things start to get interesting. They'll teach you how it works, but not so much how just anyone can get started. And they definitely keep secret how to avoid misusing the strategy. My name is Slater Smith, Yale University graduate and founder of LLIS Financial, and I have four goals to cover for you in this video. First, I'll show you how the most intelligent investors make a single asset do multiple jobs at once. Then, we'll look at how affluent business owners like Elon Musk create cash flow without a tax bill. With that locked in, I'll show you exactly where the buy, borrow, die strategy breaks down before you end up making a costly mistake. And last, but definitely not least, I'll show you the asset my clients use to make this whole approach bulletproof. But if you're impatient, you can download the free guide linked in the description that will describe 10 benefits of leveraging my go to solution. Speaking of impatience, we all know someone who loves to shop. They just can't wait to swipe their credit cards. Whether it's the local fashion mall or luxury online stores, their cart is always full of the same brands: Sephora, Gucci, Allen Edmonds, Rolex, and all the rest. Most people will preach that spending so much is a bad habit. I disagree. Behaviors are fundamentally neutral. The act of buying can be good or evil. It's where your cash flows that makes all the difference. What you need to understand is that the financially savvy don't simply buy, they invest. Appreciating assets are their bread and butter. A car loses 10% of its value the moment you drive it off the lot. The stock market grows 10% every year on average. But here's where your creativity comes in. It's not enough to acquire assets that simply go up in value. You ought to look for assets that serve multiple functions at once. I have an accountant friend named Ryan, and his specialty is cost segregation. He goes into the balance sheets of manufacturers and real estate investors with a single goal to achieve: figure out which depreciating assets can be written off: equipment, roofs, flooring, and the like. In the short term, Ryan provides a tax deduction for the owner, but in the long term, the owner enjoys the growth of their appreciating asset. Do you see what I mean? The appreciating asset is the wrapper. It reduces your tax bill while scaling your net worth. One investment, two jobs. That's the power of the buy phase. And as you'll see, this principle runs through everything we're about to cover. Let's take a look at an example. You probably remember the utter chaos that ensued when Elon Musk announced that he would buy Twitter. Personally, I thought it was a joke at first, but fortunately, I didn't put any money on the betting table. But in all seriousness, have you ever wondered how he actually pulled it off? We're talking about a $44 billion transaction. We all know he's rich, but does he really have that kind of cash just stashed under his mattress? Well, no, he doesn't. Elon is smarter than that. His wealth is in his businesses. So he borrowed against his Tesla shares to buy Twitter. And get this, borrowed money isn't income, therefore, it can't be taxed. Think about what that means in practice. Elon's shares kept appreciating. He got the liquidity he needed, and he paid zero tax to get there. One asset, three functions. Now compare that to the alternative: sell Tesla stock, pay a massive tax bill, and weaken his status as the company's largest shareholder. The better option is obvious, except that's not the full story. If you want to succeed at borrowing strategically, you need to know what happened next. Because Elon did sell shares and paid hefty tax bills, not because he wanted to, but because he didn't have a choice. In 2022, Tesla stock tanked by 65%, and his lender wasn't happy about that. When your collateral loses most of its value, lenders call the loan, meaning you either have to pay it back on the spot or put up more collateral to make up the difference. Elon chose to pay it back. That meant selling shares to get the money, which is exactly what he was trying to avoid. This is the scariest fact about the buy, borrow, die strategy. Appreciating assets don't always appreciate. And when they don't, your bank will be the first to remind you that debt is a liability. But there's a silver lining to all of this. It's clear that the ideal asset for this strategy isn't just one that tends to grow, it's one that's guaranteed to grow. That way, a loan call can never be triggered in the first place. That asset is my specialty, but don't worry, we'll get there soon enough. And there's more info in the description that you can access anyways. For now, we have to look at where most buy, borrow, die videos stop thinking critically. Consider this scenario. 20 years ago, you bought a rental property for $100,000, but today it's valued at 1 million. If you sell that for retirement income, that's 900K in taxable gains. After the IRS gets their cut, your seven-figure property suddenly starts looking more like 700,000. So, we'll take a page out of Elon Musk's book. You borrow against it. You live off the loan proceeds in retirement. When you die, your children inherit the property with a step up in cost basis. Simply put, your children will owe no tax on the growth. If they sell for 1 million, they pocket 1 million and use those proceeds to pay off your outstanding loan balance. That's where most videos on this topic end. It sounds like a good deal once you die, but let's review that loan balance for just a moment. $1 million property, $700,000 loan, 7% interest. When you do the math, that's nearly 50 grand in annual interest payments. Your expectation was to avoid a $300,000 check while leaving your family with a tax efficient legacy. But just 6 years into retirement, you've nearly paid that much in interest alone. So if you're planning for a standard 30-year retirement, well, let's just put it this way. By the time your youngest finishes college, the interest payments will have swallowed up the very generational wealth you are trying to create for them. This is why tax attorney Jasmine DeLucci warns against over leveraging yourself.
But this is a strategy that a lot of well-off people will use because, of course, you don't have to pay tax on loan money. I do think that a lot of times this tax benefit is exaggerated. It provides a huge benefit, but at some point, those loans do have to be paid back. So usually what I see is people that are well-off will get a huge benefit from this, but do still have forms of income that they are paying tax on. And for actual tax law from a tax attorney, subscribe.
The buy, borrow, die strategy is meant to profit on a spread. You're supposed to buy assets that appreciate faster than loan interest can accrue. A single family rental for an apartment complex, a cramped office for a spacious building that lets you keep hiring, or even electric car company shares for a global social media platform. The moment you stop reinvesting, the moment you just want to retire in peace, that's when borrowed money will eat you alive. Otherwise, like Jasmine said, you're better off using taxable income. So, what's the solution? Think back to the principle we started with. The best assets don't serve a single purpose, they work on multiple levels simultaneously. That's exactly where every flaw we've uncovered becomes prominent. Business shares usually go up, but when the market is down, the lender comes calling. Real estate might provide a nice step up in basis, but you have to be careful with how long you let interest accrue. There's always a weak point lurking in the back, and the strategy falls apart once that Achilles heel is sniped. So, what if you owned a Swiss Army knife instead? That is to say, an asset that does so many things well that it doesn't have any particular weakness. That's exactly what I set up for my business owner clients to prepare them for a fulfilling retirement. It's called whole life insurance, and here are some of the benefits. For starters, it grows every single year, guaranteed by law. So, that situation Elon ran into, where he was forced to sell and pay his lender, that can't happen here. And when you're gone, the death benefit kicks in. Even after accounting for any outstanding loans, your heirs could still walk away with much more than you ever put in, completely income tax free. Most assets can't even come close to that. As for the retirement income problem, I got that covered. I follow a specific strategy to keep policy loans small and infrequent. Instead of racing against the high cost of interest, you're building wealth passively. This is the buy, borrow, die strategy in its peak form. But to see how reports from a Princeton PhD and a top US accounting firm validate this life insurance retirement strategy, watch the video in the center of the screen next.